Hi, I'm Cindy Beaulieu, the CIO of Conning North America. Tariff proposals certainly created a lot of challenges for the markets, but we really look at them as the match that kind of sparked the fire. As we think about the way markets entered this year, there was too much euphoria built around the expected success of the Trump agenda, and that led to very high equity market valuations in what was already a highly concentrated market, so that made it even more difficult. Spreads came into the year across most sectors very tight, and so there was not any room for disappointment. We saw the fact that, yes, the Republicans controlled Congress and controlled the executive branch certainly could mean that Trump could get a lot done, but we were taking a more cautious and patient approach to that, thinking that it could actually be a little bit difficult for things to happen as fast as the market wanted. So all it took was the whiff of these tariffs, and certainly April 2nd, to create an awful lot of issues for the market and a bit of a spiraling, frankly, out of control with valuations as people panicked. The reality is Trump's plans to try to deregulate, to bring tariffs across nations that he felt were treating us unfairly, and to bring forward a tax proposal that would put money back in America's pockets, that all seemed pretty logical, but it's going to take time, and markets didn't have the patience for that. So tariffs were, as I said, the match to all of this that really started the market downfall, but in and of themselves, they were just the excuse the markets needed to really get back to something that looks a little bit more normal as we think about where valuations are at this point in time. So for the indicators, it is kind of interesting. One of the things we're certainly watching very closely because there's a lot of concern about the risk of this spiraling into a bear market, particularly for equities. So we're watching a lot of support levels across the major indices to see if they're breached and if that breach holds. That's been one thing we've certainly seen throughout these last few weeks, is that we can break down through lower levels, but then it just takes one little bit of good news to get us back to something that looks a little bit more realistic. So we're watching those support levels. For the bond market, we're certainly watching where interest rates are going. It has been very interesting to see what has happened in terms of the volatility of interest rates, and yet not that impressive of a spread move across most sectors. As you would expect in a period like this, we have seen spreads move wider in lower rated securities, particularly high yield, and we've seen spreads move wider as you think about moving down the stack in structured securities. But away from that, most of the rest of fixed income really hasn't widened that much. So that does tell you a little bit about how people maybe are trying to look through all of this. And certainly when we got the 90-day pause, that seemed to give people a bit of a relief valve, a release valve, if you will, to kind of let things stabilize a bit. But we're in that 90 days now. And so we are certainly subject to more volatility and more headline risk, and we seem to be getting it every day. So we're not ignoring that at all. But what really comes down to, for the fixed income markets in particular, is a combination of the hard and the soft data. The soft data is tricky. It can be unreliable, and it can give you bad signals, and it can also prove to be quite volatile. So you need to look at that in conjunction with the hard data, which we have been focused on for a while. Monitoring the levels of unemployment and how the labor markets have performed, they remain in a pretty solid state. You think about where the consumer has been and the demand from the consumer, it's still been fairly resilient even through all of this. But then you have to look at the problem, which is inflation. And that's before the word tariff was even spoken. The Fed was already battling high levels of inflation. And so we are monitoring that closely. We are not in the camp that it is a one-for-one tariff to inflation. We look at it more as a tax. But it still doesn't change the fact that people are very fearful about the direction of inflation, and it's only going to take a little whiff of higher levels to get people more concerned. So we're monitoring all of that, and certainly what it means for monetary policy. We think they don't do much for the balance of this year, but it's an awful lot of things I just listed in a very complicated market, and it is subject to, as I said, a lot of headline risk. So one thing that we've learned, certainly after operating through many cycles and periods where we have heightened volatility, is to stay calm. It never helps to make decisions out of panic. It doesn't work well. In the end, you end up regretting the decision you made. So that calmness is important. Looking through a lot of this noise, a lot of the headlines, and really trying to find the real information that could move the economy in a different direction. Those are the important things to focus on. And certainly, as we look for opportunities, it's fundamentals first, being very careful that whatever we decide to invest in a period like this is supported by its fundamentals, and we're not trying to take opportunities just because something looks cheap. That's not the way we think about markets. And to be patient. Like I said, spreads, really, the movement we've seen so far has not been that impressive. So be patient, wait for those opportunities to come. If this really is the start of a broader economic downturn, we will see that reflected in spreads, and we will have opportunities to add securities to our client portfolios at levels that are much cheaper than what we're seeing today.